Hi everyone, we continue to be at a very interesting juncture on the markets as they rebound from extreme conditions. But what I'd really like to talk about today is bubble talk. Bubble talk that starts making rounds every time the markets drop off. And I wouldn't mind admitting that I'm also prone to it because. Uh, like everyone, we are all become very aware of the uh, global debt problem. Nobody really knows the end solution, and but then this problem has been building up for so long that it's been around as a cyclical factor that will impact at some point of time. But every time we get this market drop off, I find a lot of social media and a lot of talk about trends that will just continue to extrapolate into the future, and somehow many of those things don't always play out as thought. So it really takes you all the way back to I recall as early as in the early 90s hearing about the Bearings Bank, for example, and it was thought that the a disaster could be so big that it could bring down uh, the whole financial sector of the world. That's what was being written about way back then, and the way it was told to me, and I couldn't really understand why that would be the case, but eventually it was bailed out and stopped right there. And I think those that's been the way things have moved ahead from there, whether it was LTCM and the subsequent bailout, uh, and then we finally got what could become a case for a real global bubble, which was the housing bubble, especially with the mortgage-backed securities that were sold around the world, and that's why it was a global bubble. They were held by banks everywhere, considered as safe securities, and so in a globalized environment, essentially a global bubble is going to be something that impacts everyone and anyone. And so that talk came back very strongly in the recent sell-off. But what surprised me, and why I'm making this specific note, and I spoke about it last week, even as I saw extreme negative sentiment as a reason for the markets to bounce back, was that a lot of the reasons being given appeared slightly out of context. I mean, I can say crude is a bubble, and that's the cause of bringing everything down, and copper as a lead indicator of the economy. But when you actually look at these charts and you put them along, maybe with the U.S. indices or global equity indices, they're not exactly happened in that format. So that's so you need to really look into that and then understand what's going on, because I think the global financial crisis of 2009 could have gotten much worse, but it didn't, because the same plan which was followed at a smaller degree with the earlier bailouts was followed with this big global problem as well, to keep it from spreading. A lot of money was pumped in and bailouts were done at a much larger and larger degree. So that brings me to this chart of copper, and to think about it, how many people would have forecast all the moves, say that it bottomed in 2002, would have risen, all the way to 2008, even more after the big sell-off we saw in 2008, the rally in 2009, 10, 11, all the way to a new high, a new all-time high in copper. I think that would have been most unthought of at that point of time. And at that point of time, we only had QE1 that had been conducted. We hadn't really reached the point of QE3 as yet. So as we talk, I've pasted the chart of the Dow right on top on that chart, and I'm going to move it to a semi-log scale to make it scalable. The point of making this comparison is essentially to show that uh, everything is not exactly as it looks. So when we look at the bottom in commodity prices here, they occurred way ahead. The lowest point in copper occurred way ahead of the final bottom in US equity, which occurred here. And then after that, all of this moved up together into 2008, which essentially would be not just US equity boom, but it was one of emerging markets. And the dollar throughout that period was falling, so essentially a lot of money was moving out of the US. The stimulus that was taking place there was pushing a lot of that money for higher yield into various other asset classes, which included emerging markets and commodities. So essentially, what all of this captures is the way money is flowing, and money flows from different asset classes to different asset classes, equities, commodities, bullion, currencies, and from country to country. And that is what, and currencies actually are one of the best reflection of how money is moving. The second is, now as long as, while on the one side we can keep talking about the debt contraction, but as long as we haven't reached that point, what we are looking on various charts is essentially the movement of money on one place to the next, and that continues till you reach a point where the bubble reaches an extreme where it pops. But uh, has it already happened is going to be the tough question. And was crude that signal? Well, a lot of people are starting to look at it as that signal. When I just look at this chart and I look at the logic, I'm not really convinced. Maybe if it is the case, I could be wrong. But just look at this. Copper, for example, peaked in 2011, in early 2011, essentially where the Greek crisis started in the US, was actually downgraded by the S&P, which to me actually is quite a joke because it was downgraded because they were hitting a debt ceiling. This year, just a couple of months back, the debt ceiling into the final election year for the US has actually been revoked. There's no debt ceiling anymore. So what was all the cry about? So a lot of what is published and said so loudly in the media ends up being something which is actually not relevant. After all, if you want to spend more money, you can spend as much as you want. And what's the meaning of a ceiling that can be changed by law at any point of time? So the essence remains that continuity is uh, the point, that you want to continue with the current trends and not deviate from them uh, till actually something goes out of control. So in that sense, when exactly did QE3 start? It started exactly here when the Greek crisis was actually reaching its final conclusive bailout stage, the first bailout that they did in 2011, and exactly around there, QE3 was announced. Did commodity prices go up? No. Copper had already peaked, and soon you got a top in gold and crude and so on, and they were actually falling through at that time period. So essentially, what QE3 meant is people who were speculating and already holding big positions in commodities simply moved out from commodities to currencies. That is how I would, sorry, commodities to equities. That is how I would look at this chart, which is very similar to how we look at maybe the equity and bond. If you're looking at US equities and US 10-year bonds, you would always see them inversely correlated because money just tends to move out of equities, it goes into bonds, or it goes into money market instruments or some kind of short-term financial instruments till they decide that they want to be back in equities again. So that's the simple asset allocation that takes place within the US itself. And now that most people trade multiple assets, it also happens like this. So a lot of money moved out of commodities into equities is what this chart tells me. You've still not reached the point where you had any major default, any major shutdown of banks post 2009 to really say that you've got a global calamity at hand. Crude prices are down, they can cause trouble, yes, if all the companies that are producing crude shut down, but that never happens in commodities. The typical cycle is that couple of capacities shut down, the demand supply gap narrows, and the cycle turns. Unless, of course, global growth is completely stalled. I can either agree with people who say these growth numbers are all false everywhere, but nominal numbers still growing at 2-3% without the pop of the bubble means something is still going on. Whatever is cooking is still going on. So simply calling it the end on that might not be a fair argument. And so that leads me to the next thought. I've been talking about the potential where the dollar index could actually fall again. The dollar index peaked last year in March and has not been able to surpass that. And even as Japan has announced more QE, and definitely the yen could weaken more. I'm still not so sure about the euro because it looked completed in terms of an ABC structure. So I've been writing about the euro starting to strengthen rather than weaken, though we did get a big move yesterday. It's not enough really to change that opinion. Now, so the point here is, and a lot of the weakest currencies, and I've written about them all of last week, all the posts you'll find on the website, on each and every one of them. The ones that were weakening, the ones I was looking at really falling off, whether it was the Brazilian real, Australian dollar, Canadian dollar, and so on. USD XXX, any contract you take, and they have started to strengthen over the last week. Some of them from extreme overbought conditions, some of them from fifth waves, at least at some degree, if maybe not the long term, at least the third wave may be ending. And so that can mean months or weeks of consolidation. So essentially, the rising dollar trend appears to me at the fag end of itself, and that's why that was among the many reasons why I thought we were in for a relief. Now, the question is, what does it then mean for commodities? Typical answer would be they cannot go to new highs. The world is slowing down. Definitely, you have slower growth in the US this quarter, which is similar to what you had a year back. I have no idea how the US is going to do for the rest of the year. But the increasing talk that you're hearing from either the IMF or the central banks is, well, uh, QE is at the end of the road, sure, but there are other things that can be done. Even Raghuram Rajan recently said it at the WEF, and they're talking about structural reforms and and government action. What does government action mean? It actually means spending money, which means fiscal stimulus or fiscal spending, deficit financing, whatever word or terminology you use, one of those has to come in at some point of time. And how much more QE are you going to do? So that's a question mark. But at the same time, the current policies of cutting rates down continues. So the Bank of Japan recently cut yields. Europe did it in early part of this month, and probably it would continue. So if you ask me what is the RBI going to do, I would think they're going to cut rates. The environment is perfect because economic growth is slowing down, commodity prices are down. It's ideal for him to actually cut rates now. Though a quarterback most would have thought he's not going to do it now. He'll probably do it only after the budget or something. But then that's what I would have thought a year back, and then they just popped in the mid of Jan and cut rates. So the environment right now, 2 days into the rate decision, is exactly that he should be looking at cutting rates, even though he's going to say that we can't keep doing this and the banking sector needs to reform and so on, which are real issues because then you can't really push lower rates down the line with banks beyond a point if they don't clean up their balance sheets first. But however, he's going to continue to keep trying. So between the talk and what action might happen, it's just my sense. If he's going to do what all central banks are doing, we're probably going to see one more small rate cut and maybe a pause after that. But the question is what a commodity is going to do. And so I'm looking at this chart of copper and wondering if the dollar starts falling, if it does actually, if you do get that euro rally later on. And I know most thinking that, well, Europe is going to do QE in March. The dollar cannot go down, it has to go up. The most recent sentiment readings on the dollar, at least up to a couple of days back, was almost over 90% bullish on based on the daily sentiment index surveys, which means almost everybody is bullish on the dollar. And that's exactly the sentiment I was getting the feelers of in the early part of this month, based on how all the tweets and messages floating around, from the foreign fund people who are probably bullish on the dollar, saying that this is just going to go up, go up, go up, go up, and well, we're still not past the April high 9 months earlier. So essentially, that trade is not in the dollar index; it's in the other currencies, which I did say earlier were going to weaken. But now, as their final legs of this move are done, I guess the sense is that the dollar would go the other way. For some reason, I don't know why. Whatever stimulus might come out in March from Europe might not be that big. Who knows? But what if the dollar starts falling? Why can't commodities rally again? So that's the question I'm trying to raise. I tried making this forecast almost a year back that if copper was at 61% retracement, can it once again attempt the highs? Right now, talking about copper bouncing back and attempting the highs is like stupidity in no man's land. But the point is, if you look at the entire structure post 2000, it would look completely incomplete. For example, how are you going to mark these waves? Are you going to say this is an expanded flat? Are you going to say this is A and this is B? You could, because B is essentially at 123%. But if this is an expanded flat, wave C should be a 5-wave decline in impulse. And this entire decline so far is not an impulse. So it is a complex wave. We can argue that this is a top and we are done W, X, and we'll only probably do Y and X. That's a fair argument, but what I'm trying to get at here is there is absolutely no way that I can rule out that a move ends up being bigger. And now put that in perspective with well, you are getting slower growth around the world, and apart from rate cuts that are unlikely to work, what is the next that's going to happen? Structural reforms and fiscal spending. So the thing that's really bothering me, and that was going to be part of my economic note and will be whenever I get down to finally publishing it, is uh, are we really going to then eventually move towards inflation and hyperinflation, something that most people thought would happen on QE3? It didn't happen in commodities and in prices, but it happened in stocks. Is it going to happen in commodities? We haven't seen a major bubble pop yet, and we haven't seen a major disaster yet. We've seen fear of disaster definitely to the highest degree, such that many sentiment readings reached levels that you've seen only at the bottom of 2009. Fair enough, because after all, commodity prices have fallen that much, but equities have not, which means at this point in the US, the put call ratios were as high as they were at this point in the US. Now, that's a little insane, and that's similar to what we've seen even in Indian markets, as I showed in certain sentiment data. They did go out of whack. Some very oversold readings in some stocks, like Larsen, for example, which you only seen at major bottoms or at medium term lows. So when you're seeing those kind of readings, something else could likely happen, and you need to weigh that in. And if everyone starts spending money to get growth back, which is still talk, at least in India, we are saying we're going to stick to the fiscal, but that might not be the case everywhere. Uh, and at some point, if you do see a change in the pattern or in the way that uh, stimulus is being conducted, which is not just QE, because that's not working anymore, and some other format, whatever that may be, whatever that innovation is. Because the object of that innovation, if it's going to be inflation, which means trying to send money directly into the hands of people who could spend it and drive prices higher, then prices are going to go higher. And so that's the fact which I think most are unprepared for. Most are just looking for bounces. They're telling you crude cannot go up at all. And I'm wondering, I mean, a normal bounce on crude could be 40. I mean, $35 is barely a bounce. To me, $38 is a normal fourth wave of previous degree going up in a normal bear market. Anything bigger would mean going back to $45, $50, maybe retesting the $60 major high that we saw just 2 months ago. So not a big deal. And so that would be normal again as a medium term rally, and then you could say, well, from 60 it will come back to 20 and 10 or some thing like that. But is it really going to happen? And that's the big question, because if you're going to get spending all over again and inflation all over again, then these are not prices that are going to hold. And so is the game really one going to move from inverse correlation between commodities equities to a direct correlation? And this is the big question of the day. I will try to answer it as I continue to look at charts, reversals, and as the trend develops. But I am more mentally open to the idea that we, at the end of a deflationary period, because we already have deflation, why shouldn't you be anticipating an inflationary period? Ask yourself that. Why shouldn't the various central banks or governments around the world at some point in the coming months take actions to stimulate again if really growth is slowing down, and why aren't you thinking about that? So that's the big question of the day. And it's very easy to say that, well, the debts will collapse, but before that, if they start spending money, the debt collapse might just get postponed for some more time. So these are the things you need to watch for very closely in terms of what the charts are doing. And one of the charts that I've watched all year round to try and determine that is to look for where exactly the third wave for US bonds will occur. So remember, US bonds actually fell in 2013, and when this big leg down happened is essentially when the rupee went from to 69 and Indian bond yields really shot up, and Raghuram Rajan was brought in. So this happened exactly in this phase from year to year. The point is, when does the third wave down for US bonds start? I've been trying to anticipate it. I thought 61% was a good number, but as you see, more than a year ago, after the 61% retracement year, we haven't really seen an impulsive sell-off. It's making multiple up-down moves. I thought maybe this would be a triangle and B and then C down. Frankly, that's not happened. We've actually broken out of this falling trend just now. So much for talk of global debt bubble or sovereign debt collapsing. It's not collapsing. It's going the other way. At least US debt and so that means we are just going to delay the third wave. So, and that's the big event, the real big event that you're looking for in global bubble. If it's really sovereign debt bubble or something like that, then it's going to be when the third wave down for US debt actually starts. And right now we're looking at an upward move that is attempting to break out of this line. And if it does, it would mean that, well, you're going to retrace all the way up here. Not a new high, but wave 2 could retrace not 61 but 78% up here, and that would well postpone the final crisis period uh, uh, a little more ahead into time, maybe into the second half of this year. And So that's going to be what you're going to be watching for. If you need to look for a crisis, you need to find it on the charts. And I will continue to cover all of these charts as I do on India charts day after day. So that's all in this update. I've given you a lot of insight. Things can go either way. You need to be open to both sides of the trade in the market as it goes. We can't get stuck to one side of the story, and when sentiment is so extremely negative and nothing has happened yet, then you need to think about the potential on the other side. That's all in this update. Thank you.